This is the story about two friends, Rohit and Umesh. Umesh is an old-time investor in mutual funds and Rohit also wants to invest in mutual funds. He inquires about it from Umesh. Rohit asks Umesh how to invest in mutual funds in order to get good returns. Umesh tells him about Equity Sectoral Technology Fund in which he had invested. He also got a good return from it. Rohit is excited and he also invests in it. After 1 year, Rohit looked at the performance of his fund. He saw that the fund has given a negative return of 9%. It basically means that his initial investment has declined. He got stressed after this.
Let's start with what is a sectoral or a sectoral focused fund. These funds invest in mid-cap, small-cap and large-cap stocks of a sector. When the market is going up, the sectoral fund gives a good amount of return. Sectoral focused fund is the riskiest equity mutual fund. The reason for that is that there is no diversification in it. Investment is confined to just one sector. During unfavorable times, if a sector gets badly hit, then its stocks will also fall sharply. Such investment is only for seasoned investor who can gauge the direction of a sector.
Now let us talk about why Rohit is in a loss despite investing in a good sectoral fund. Umesh told him about a good sectoral fund, but he missed one important factor. That is, to consider your risk appetite before making an investment. Umesh himself has a high risk appetite and he has an experience in investing. He knows how sectoral fund works. On the other hand, Rohit is a risk-averse investor. He doesn't want to take high risk. His risk appetite is low to medium. He wants to invest in a stable and safe investment option.
For example, small cap and mid cap stocks are riskier than large cap. So, if an investor is looking for limited risk, then he can invest in large cap funds. His return will be lower but much safer. Hence, this fund is good for long-term investors. Similarly, there is a high risk in small cap funds and there is huge volatility. During uncertainty in the market, volatility intensifies in the small cap shares. On the bright side, if the market is moving up, then these shares give very high return.
Now the question is, what should Rohit do? First of all, they need to be specific about their goal, risk appetite and opt for mutual fund accordingly. Mutual funds invest in all kinds of assets like equity, debt, corporate bonds, government securities, shares of different sectors, etc. Value of these funds vary dynamically due to load of factors.
Due to the changes in the market, the NAV of a fund declines and due to this, investors bear the losses. Hence, it is important to know about your risk profile and then invest in a fund that matches it.
Let's come back to Rohit and Umesh. After understanding all of this, Rohit was confused about how to assess his own risk level. Umesh explained that on the website of a mutual fund, when you look at a scheme, it will also have a riskometer. It is also given in the physical document that is provided during the NFO. In this, risk about scheme is depicted in the form of a graph. In the mutual fund riskometer, there are 5 categories of risk. There is a different color for each category. On the 10th of every month, mutual fund houses have to publish a portfolio and the riskometer of schemes.
If you are investing in a mutual fund, then you need to keep in mind these few things. You have to understand about the nature and the target of a fund. Also, look at its riskometer to assess the risk associated in a fund. Even after all of this, if you are unable to assess your risk profile, then consult a financial advisor. He can understand your financial condition in a better way and will suggest a scheme accordingly.